All right, everybody. Ladies and gentlemen, hello and welcome here to our webinar at Nadex. My name is Philip and I will be once again your presenter for today's webinar, The Market Movers for today, for the 7th of February 2017. Just a second while I switch the first title slide. Yeah, that's working. All right, guys, if you have a look at your webinar interface, you can see that small questions box. And please, if anything is not clear during this presentation, let me know using that questions box. Right now, I would appreciate a very short yes or why in that box to just let me know that both the audio and the screencast are working properly. Today's webinar is scheduled to run for about half an hour, and of course, before we get started, thank you very much, everybody, for giving me the feedback on the audio and the video. Really appreciate it. Seems to be working well, so thanks for that. Of course, before we get started, there are our usual risk disclaimers, so please take a moment of your time to read through them carefully and make sure that you're okay with them before continuing with the webinar. Essentially, this says that trading, of course, involves risk, and that you should understand these risks and the risk associated with the instruments you are using before you are getting active in the market. As neither Trade with Position nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only, especially true for the live part of today's webinar. We will be looking at the markets as they are right now, live streaming quotes and everything. Possible potential ways to trade those markets in one direction or the other. It's just education. I'm sharing with you what I'm seeing on those charts. It's never a recommendation to buy or sell or take any position in those markets based on just what we've been saying. All right, so please make sure you're okay with this before continuing with the webinar. And we have another risk warning this time directly coming from Nadex. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purpose only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not indicative of future results. Nadex instruments include forex, stock indices, commodity futures, and economic events. Nadex binary options and spreads can be volatile, and investors risk losing their investment on any given transaction. However, the limited risk nature of Nadex contracts ensures investors cannot lose more than the cost to enter those transactions. Nadex is subject to US regulatory oversight by the CFTC. And that being said, we've got a lot to cover, so let's just get started. Let's have a look at today's agenda. We want to show you charts of markets which personally I think might be interesting right now, and we will be discussing what type of strategies and setups we're looking for here with our trade with position strategies. We have two decisive strategies that we're looking for in those markets, and I will show you on the charts what I'm seeing there, why I think those markets might be interesting. Of course, it's just what I'm seeing there. You might be in complete disagreement, or you might say, yeah, I can understand what you're seeing there. In the end, it's always your call. Yeah, market scenarios, possible outcomes, and setups to consider. And we also, just a second, yeah, market moving news events for the week ahead. We want to see what might be hitting the wire there also over the next few days. All right, major part for today, live trading and analysis, and this is where I directly jump over to the markets and later on to the live platform. You might not tell me, Philip, we're here at Nadex, so why do you show me those charts? Why not just have a look at the Nadex platform itself? My personal take on trading, which is in line with my colleagues here at Trade with Position, is always I want to see a setup in the market first. I want to see a reason why. I always compare it to a journey. I want to see a reason why I would want to get from place A to place B. And only once I've understood that I want to move from place A to place B, then I have to decide how do I want to get there. I could go there by foot. I could ride my bike. I could ride my motorcycle. I could go by car, train, plane, you name it. But at first I have to understand that I want to get from A to B. And with trading, it's just the same thing. Once you, and only you, can arrive at that conclusion that you want to open a long or short position in any market, then the next decision you have to make is, okay, how do I want to trade that market? And you can trade directly the underlying market, you can buy stocks, you can buy index futures, you can buy normal plain vanilla options, or you can go for innovative trading instruments like those that you can trade here at Nadex, binary options and binary spreads. And there are benefits associated with every investment class, and there are some disadvantages. So for example, the very big advantage that we have when we're trading Nadex options is you have a clearly well-defined exposure, well-defined downside of those trades. At the moment where you raise your order, I will show you this in just a moment, you will realize this is the maximum I can make on that trade if it's a potential winner, or if it's a potentially profitable trade, or I know exactly how much I can lose if that trade is not working the way I want it to work. And so you have this completely well-defined position, which is a huge advantage to pretty much any other investment instrument that you can pick for implementing your strategies. But first, you always have to think about, what is my strategy? Why am I interested in a market or not? And I've picked here today silver, and yeah, here's my mouse. Why do I think silver might be interesting right now? And with our strategies, we're always looking for multiple reasons why a setup, why a chart might be interesting. And one of those reasons is always we want to see multiple time frames in agreement. So I'm starting my analysis here now on the monthly chart. And you can see that silver had a huge rundown from 2011 to round about the beginning of 2016. And ever since then, price has started to rise and it has come back down again. But please note, the low that we just recently made here has been a higher low. And our strategies are trend following strategies, which means we look for setups which are in line with the trend. Now, how can I assess what the trend of a market is? Well, I'm just looking at those highs and lows in the market. And what I can see here is the price made clearly a new higher high. I compare it to that high over there. That was the most recent high. It made a low, and this low already was it a lower? Yeah, it was a lower low still. But the high we made here clearly was a higher high, and now we've pulled back to form another low. And this low has been definitely a higher low if we compare those previous, the previous low and the current one. And since then, price has started to push higher again. Next thing that I notice is I can see that the 10-period moving average has moved above the 20-period moving average. They are now very close here to the 50. I want those to fall in line. Here they've fallen into line. Here I see that we have been clearly in a downtrend. I want to see the same thing happen here for an uptrend. It's not there yet, but however, the monthly chart clearly shows me the early stages of a new uptrend, and I want to see further confirmation. But the major momentum that I take from that chart here is currently to the upside. That's the monthly chart. Now I'm drilling down. I'm looking next at the weekly chart. The weekly chart has been here in a clear downtrend. Why was it a downtrend? Well, we made lower highs and we made lower lows. As long as we get lower lows and lower highs, that's a clear downtrend. However, just recently, this high here was a new higher high compared to that one before. So with a lower low being followed by a higher high, clearly it's no longer a downtrend that is in place here. That trend might be changing now to a new uptrend. Shazia, and I hope I pronounced your name correctly, thanks for that question. Can you tell which those indicators are that you're using? Sure, happy to do so. And by the way, those indicators are the same on every market and on every different time frame. I'm not looking at different indicators if I'm looking at a 5-minute chart. It's always the same thing. We're looking here at 4 different moving averages. We're looking at a black 10-period moving average, a blue 20-period moving average, a red 50-period moving average, and a green 200-period moving average. And essentially what I want to see is I want to see this fanning pattern that we can see here. I want to see that those moving averages are well separated from each other. They are pushing higher, they're pointing in the same direction, and this is pretty much the major part which I'm using those moving averages for. The 10 and 20 also form my moving average buy zone in an uptrend and the sell zone in a downtrend. You can see here in this short uptrend that every time price pushes higher, at one point it starts to pull back. Where does it pull back to? We have found with our research that there's a decent probability, decent chance the price might be pulling back just back here into this area identified approximately by the 10 and 20 period moving average. We are not interested in crossovers. We are not interested in price touching or crossing certain moving averages. And for that reason, it doesn't really matter if you want to look at simple moving averages or exponential ones. The basic usage just remains the same. Try both if you want to follow our methodology. See what you personally like best and what you want to use there. So these are those moving averages, 10, 20, 50, and 200. Then we have two more indicators on our chart. Here we're looking at MACD. And this is MACD with the standard box settings. Standard default parameters 12, 26, 9. And here we are also just looking at the black line. I'm not interested in this moving average of the black line. I'm not interested in the histogram. I just want to see what my black line is doing. And what I want to see here is that every time that price makes a new higher high, I want to see that I can get the same higher high in MACD and also here in RSI, which is running with the 14 period parameter in place. So I'm using those indicators just to scan for convergence, or I'll look for divergence as an early warning sign that a trend might be running out of steam, out of momentum. And that's pretty much all that we're using here for our analysis. Most important for us, trend and reading price action. And our indicators just help us to do that faster than just by looking at price action alone. However, we have to understand that those indicators are really redundant. They just take price action, they do some fancy mathematics with it, and they come up with one or more other values. But as only price goes into the calculation of those indicators, it's only a different representation about what price had been doing in the past that can be that they can show us. And for that reason, if you understand what price is doing here, that this here starts to turn out to be a slightly bullish candle, why those candles here are bullish, why this candle here was pretty bearish as was the one before, that's the most important part I think that there is to trading. You have to understand those charts and be able to read them properly. Pull back, higher high, about to turn place now here also to a new fresh uptrend, still a little bit early to call it an uptrend, but it's pushing in that direction. So the weekly also suggests some good momentum going on here. And now if we have a look at the daily chart, and I have a lot of different levels here on my chart, and let me just remove, let's keep them. Just remove on those areas here around this level of 1760, 1750, something like that here in this area. You can see that price has tested those levels several times in the past. Price has reacted to those levels. And we put those levels on our charts and they stay there. We do not believe in sloping trend lines. They change too often. They are too hard to read. They are too hard to act upon. However, those flat horizontal lines, just like here, you see the market defined those levels back here in the day, and now we've come back, and where have we seen some stalling in price momentum going on here? Exactly at those levels. And now it seems that we've slightly broken above those levels. We have to see where this candle here closes today, but I think there's a decent chance that we see some good momentum going on here also on the daily chart. Daily chart, what is the trend? Once again, we have higher highs, we have higher lows, so clearly we are now in an uptrend again. This pullback here was a little bit deep. Here the uptrend was for a short time in jeopardy. However, once we started to make new higher highs again, this short pullback, I think it's safe to call this now an uptrend. Those higher highs beautifully being confirmed by our readings in MACD and in RSI, so everything in silver here is really currently pointing to a move to the upside. At least that's the way I'm reading those charts. You might be completely disagreeing. You might say it has been rising for far too long. Definitely it's now due to a pullback. That's the beauty of trading. Nobody is right all the time. You just have to find something that works for you, and you have to make it your personal own trade. You have to find a strategy that you truly believe in, that you have tested on paper and with your own account, and that you just know blindly, everything is there, I just put on that trade and that's it. For me, obviously, that's our trade with position trading strategies. Many different ways to trade the markets. Your assessment might be completely different. So what have we learned now by looking at those charts? Monthly, still early, but definitely pushing higher. Weekly, somewhere in between, but also good upwards momentum. Daily, also looking not too shabby either. So let's drop down with our time frames even more and have a look at those short-term time frames that we see here. We're looking here at an 8-hour chart, a 4-hour, 2-hour, 1-hour, and a 15-minute chart. And one of the patterns that we're usually looking for is a push higher and then a pull back to our moving average buy zone. In an uptrend, we can see here this fanning pattern. We see a not so small but rather smallish bullish candle setting up here in the buy zone, and depending on how you want to read those markets, that might qualify as a potential trading opportunity. So let's just assume we agree that this might be a long trading opportunity, and now only after I have identified that potential setup, now I'm switching back here to my Nadex platform, and just a second, let me make that chart big. And now I'm trying to push my platform just next to it so that we can still see what's going on here. Now, if I think that this might be a potential long opportunity, I go here to my commodity binaries, and I could be looking here at silver. Now the question is, which time frame do I want to trade? I could be looking at the 10 a.m. time frame. Obviously, that one has just expired. 11 a.m. That one has still 43 minutes and 2 seconds left. The question is, how fast do I think that this move might occur? Just for the sake of demonstration, it might be a little bit more, yeah, sure, why not go here for one of those, for those rather short-lived contracts. With binary options, it's just like with normal options. They expire at a certain point in time, which you can see here in this expiry and time left column. The market has to trade above the strike price that we see here in order for this contract to settle at $100. If it's trading below that strike price at expiry, it will settle for 0. It's binary. It's either all or nothing, 0 or 100. If it's just trading there for a short time and coming down again and closes below it, settlement will be at 0. If it pushes above there and closes there 1 minute after expiry, bad luck either, it settles at 0. So always pay attention to what the time is doing here. Now let's just assume that price might be pushing higher and we might be seeing a retest of that 1778, something like that. We could be now going here for, why not pick that contract here? Now I just picked this contract because it's not so far out of the money. Price has not to travel awfully far just to hit this level. And so I have a more decent chance that this trade might be a profitable trade in the end. However, there's never a guarantee for anything. What you can do here using those prices, and let me just open that trade, and you see how easy it is. I just clicked on buy, I clicked on the offer, one contract. My maximum loss for that contract would be, for that trade, would be $32.50. If that trade turns out to be profitable in the end, my maximum profit that could be achieved is $67.50. I know all this so much in before. I don't have to think about and worry, oh, if the market gaps against me, if prices start to move really fast, it doesn't matter to me. That's my maximum downside, that's my maximum upside with that strike and that contract picked here. So I'm just opening that trade now. The order is being processed, order received, and it just should show up in a moment. Yeah, that's my internet connection. Really sorry about that. Just a moment. Let me quickly relog here. Just a second. While the platform is reloading for me, and it takes a little bit longer than usual, Have a look at this chart structure here, and here you already start to see again this pushing higher, pulling back, candle in the buy zone, pushing higher, pulling back. You see that pattern setting up there and happening and evolving all the time. And that's pretty much one of the core strategies and trades that we're looking for here. And we're always looking to find those pullbacks. And you can see I have an open position now in this contract here. Sorry, no idea why Firefox currently didn't want to play along with me. And we're back at silver. And we're going for those short-term contracts here. So we have now opened that trade here, and again, it's an arbitrary strike price. It's not a recommendation of any kind, and you see that I just picked this one because it's a little bit out of the money, but might be still achievable. However, if I think the market might be rallying pretty hard over those last 40 minutes, I might be inclined to go really nuts and strange here and go for the one even further out of the money. I could be looking here to buy this contract. The probability that this will be a winning trade is now or profitable trade is now much smaller. The market just sees it as roughly 10%. However, maximum I can lose $16.75, maximum profit $83.25. You have an enormous, a fantastic reward to risk ratio here on that trade. So we have to keep that in mind. There are two different things we always have to balance when it comes to picking those potential, to pick those strike prices that we want to trade. The first thing is we want to have a decent reward to risk ratio in our trade. How do we get this? Well, that is the potential profit that we can make with our trade against the potential risk that we have with the maximum risk with our trade. And personally, I want to see at least a 1:1 ratio here. I don't think it makes sense. Let's just assume, okay, why not go for this contract here? The market gives me a rather large probability that this will be a winning trade. Think about it. The market could drop to 1773, round about here at this level. And only if it drops below this and closes below this level, only then would that be a losing trade. The probability that this will not happen is currently at around about 90%. Mid-price, roundabout, can be approximated as the probability that this trade will be in the money at expiry. So why am I not thrilled about that setup here? Just because I'm not thrilled doesn't mean I can't place that trade. We see the issue here. The maximum loss on that trade would be $91.50. I just bought that contract for $91.50. What is the maximum that this contract can settle for? Well, it could settle for $100 if it closes above strike price. So my maximum profit would be just $8.50 with a risk of $91.50. Decent probability that I won't be losing my $91.50. However, reward to risk is really bad on this trade. So this would never be something for my personal taste. Your assessment and your approach to trading might be, I don't care about reward to risk ratio, I'm just going for the probability. That's your trade, that's your game, you have to own it, you have to understand what you're doing there. Now, if you think this market is going down, I don't believe that this is sitting here, we have to pull back some more on the higher time frames. So we could now be moving out, we could now be moving here to our daily expiry, 1 hour left, or we could say, wait a minute, we also have contracts which expire on Friday, so 3 days out. Let's try to initiate a short position here on those 3-day contracts. Again, not because I think this market might be going down, but just for the sake of completeness, to show you how what kind of thoughts you have to think in order to pick a possible strike price and contract for a short position. If I think price might be going down, and why not think that we will see a retest of this 1772 level, and if we are looking here, and by the way guys, this is the contract here, 1775, and it's trading at 48 to 55. Every time a contract is trading at the money, which means the underlying market is trading at the strike price of this contract, the price should be close to 50. Not exactly 50, but close. And this is what we can see here: 48 to 55, close at the close to 50, close at the money. And this is also something that you can keep in mind when thinking about potential price targets. If you think price might hit this level here in the future, by rough approximation, you can think, okay, no matter what the price is here, if it's trading there, and it's trading there at the strike price, at the money, price should be close to 50. So something quite, this information can come in handy several times. So thinking this market might be going down, I'm clicking here on selling, and let's just assume I want to sell 2 contracts here. My maximum profit 95, maximum loss 105. Close to 1-to-1, not perfect, but it's working. I just placed the order received, and the position is open. Now I have 2 short contracts here on that one. I don't have to wait until this option expires in order to close that position. The idea here might be, wait a minute, I could easily try to scale out of that position, and I just clicked on my position here in the Open Positions tab, and now I'm telling the system that I want to buy 1 contract, and I don't want to buy this contract for 54.50. I think price might be coming down, and why not put in a take profit order for completely arbitrary, no relation to any price move, market move, whatever. I just put in 25. And so what I'm doing here is order received. Guys, it's not executed, it's a working order. I could now walk away from my desk. This order is sitting here at Nadex, and I know once price criteria is met, that order will be executed. This way I can easily scale out of my positions and trade those positions easily. So it's not fire and forget. You can easily manage and manage your positions and keep it that way. Or if you would say, wait a minute, I think price will be coming down even further, you could be looking and selling, for example, the 1725 contract. This contract is now selling, well, you would receive $90.25. Your maximum loss, if that contract settles above its strike price, you would have to pay that difference between 90.50 and, well, let's make it 90.50, those $9.50. On the other hand, if it settles below that strike price, which the market currently thinks to be rather unlikely, but then for a risk of just $9.50, you could have made $90.50. So just assuming, okay, I'm selling 2 of those contracts with that strike price, position is live. I just hit the bid, so the offer easily got executed there, and I could be just doing the same thing here. I could say, okay, once price really touches that level, my idea is that that option might be worth something about 55, and I want to close that complete position there. I just place the order, and this is how I would manage those positions. We are already running quite short on time. I definitely want to show you guys also the spreads. We also got a question from Chuck on binaries or spreads. And let me first show you how those spreads actually work. And just the same thing, we go to commodity spreads, we go to silver, and we have a look at the daily here. And we can see that this daily has just 56 minutes left in its life cycle. Now, the spread is defined by a floor and a ceiling. And we are now trading here somewhere 1777. And now, if I think, let's just, for the sake of demonstration, no recommendation whatsoever, think that we're looking here for a potential long trade. If I want to go long in a market, I'm looking for a spread that places the floor as close as possible to the price where the market is trading right now. The idea for that is that price has then a lot of room to participate in price moves to the upside. Let's just think about trading this contract here, 60.50, 18.50. This contract is currently trading here at 17.75 to 17.79. And what is my maximum loss? It's $129. My maximum profit is just $71. Where is this coming from? within the range of that contract, of the price range of that spread, 1650, 1850, the price of that spread moves freely. This is not a true or false event. Now we are looking here at a how deep in the money is it. Bottom floor level 1650, 1850. With the markets trading at 1775 right now, we are pretty much in the middle range, even a little bit more ahead, closer to the ceiling than the floor. So we only have a little bit of more room left to participate to a potential move to the upside. However, we have much more room left for a potential move to the downside. This is why personally I would not be so interested to pick this contract here, because I have more to lose than potentially to gain. And for that reason, personally, I would be looking here at this. But again, it's not a recommendation. Now my maximum loss is 30 and my maximum profit is 170. Why is that the case? Well, the floor here is 70.50, so actually price could just be dropping 27 cents, $30, and then I'm sitting at the floor. I can't fall any lower than the floor. However, if price now starts to rally to 1950, all this headway atop of me, that's still waiting for me. I have all this price range still left to appreciate in value with me. So I might be inclined to say, okay, with just $30 of risk, I'm placing 2 trades. How much money in the end I might be making if that turns out to be a profitable trade, 2 ifs, really depends on where this price settles. If it settles at 1950 or beyond, I make those $340. If it's just settling at 18, I'm just making $50 compared to what I pay for it. My potential profit is much smaller. So please understand, binary options are really true or false, 0 or 100. With the spreads, it depends also how deep in the money this contract will be once expiry is there and that option expires. Now the question is, what should I be trading? Should I be trading a spread or a binary? You pick your poison. You pick what you like best. Personally, I'm more leaning towards binaries, but that's just me. A lot of my friends and colleagues, they go for spreads. They like those spreads better. They like the possibility that this really moves with the market and gives them more range to be right. And personally, I'm more inclined towards this binary nature. In the end, you pick what you like best. Now, just for the sake of completeness, 70, 76, let's just assume we think that market might be going down. We might think the market might be going down big time. Why not look into selling this contract here, 1550, 1750. If I want to sell this contract, I'm looking for a contract which is trading as close as at the ceiling as possible. Why? Because I want it to drop as far as it can. If it moves against me and I'm already sitting again at the ceiling, it can't hurt me much more. And this is pretty much what we see here once we look here at our maximum loss, maximum profit. We are now trading at 1776. The ceiling starts at 1750. So currently we're sitting on top of the ceiling. Even currently, that option would be worth nothing at expiry. And this is why I'm getting that option quite cheaply. Maximum loss just $4. However, if it starts to fall and starts to fall to hit 1550, which personally I don't think is very likely, but if you think that's the scenario that's going to happen, sure enough, you go for that 1550 contract and yeah, you just place that order. You see how easy it has been to open those positions, both in spreads. I hope you've seen the idea which spread might make sense, depending on if you want to go long or short. Remember the floor and the ceiling. If you want to go long, probably finding a spread where you are currently trading at the floor makes more sense. And if you want to go short, finding a spread where you're trading more towards the ceiling might also be beneficial. Now, let me just have a look at those other questions. But I think we're pretty much good. Marlene is asking about the intrinsic value on those options. In the end, I think you're overcomplicating things. Intrinsic value makes a lot of sense with plain vanilla options. Why? Because there it makes sense to see how deep in the money those options are at expiry, because this is one-to-one going to your profit. So the upside is not limited with those, or in general, not only the upside, also the downside if you're on the wrong side of that trade. If you are, I'm just thinking about, just give me a moment. I don't want to tell you guys rubbish. The intrinsic value is not of your concern when it comes to binaries, because you have just this: is it in the money, intrinsic? Yes, then 100. If it's not in the money, then out of the money and 0. And so the level of how deep in the money it is no longer really beneficial for you. And so that whole concept, you just have to vary binary state above the level yes, no. So that's pretty much it. So with plain vanilla options, I'm completely there with you here with that one. Don't make it so, don't make it too complicated for yourself. Great instruments. You have a pretty much defined position both to the upside and to the downside. Those unlimited profit potentials that you might have with other investment instruments are not there with binaries and with spreads. However, if the market rapidly moves against you, if the Fed announces suddenly interest rate decisions, if anything crazy happens in the world, which seems to happen from time to time, the markets have the potential to move big time, and this can really screw up your positions with normal investment instruments. Here I know completely my exposure to long to the up and to the downside, and this is what makes those Nadex contracts so powerful. If you want to be very strong on your risk management and implement a very thorough and powerful risk management for your trading, I think those Nadex contracts are spot on, and they make it incredibly hard for you guys to screw up on your risk management if you take it seriously. All right, so we're already over time. Sorry about that. Just reading if there are any more questions. Shazia is asking about this platform. Just a second. No, this was Miles, sorry. No, it's not a free platform. In the end, you pick your charting platform, you pick what you like best for your trading, and which helps you to make your best trading decisions. In the end, just like everything else, it's your call what you like best. Shazia, great question. Can I close my order before the expiry time and take whatever profit is showing at that time? Let me just quickly switch back to the platform. And let's just assume I no longer want to have that trade on. Currently it's a minus position, but that doesn't matter. I'm just clicking on that trade, and it was a long position. I just want to sell this position right now. I'm clicking on the bid here. I place the order, and that position is gone. You see how easy it is to close those positions, and it just doesn't really, you don't have to hold those positions until expiry. It's easy to close in and out. Cynthia, you see, Cynthia's asking about how difficult it is to get filled. You see the bid and the ask, and if you hit the bid and the ask, no issue at all, because those are there, those are being shown, and you just hit them and the trade's through. If you want to go for if you want to play the bid and the ask, it depends on liquidity and what's going on there. Yeah, it's just like any other market. We have to see where that market is moving and what's going on there, and what the other members of the exchange are doing there. Just reading through the questions. No, Antonio is asking about spreads, if they are all or nothing. Those all or nothing, no, that's not the case. With spreads, it really depends on how deep in the money they are. Guys, I just quickly push in that last slide so that we can cut off the recording. I'm more than happy to answer your questions after that.